Okay, dear organizers, dear colleagues, I'm very happy to present the results of our research on the IFRS for SMEs, how to improve the harmonization of the EU accounting legislation for SMEs on this IFRS 2020 conference. I would like to introduce my colleague Corinna Meyer and myself, Natalja Tocelovska, as the authors for this academic article. So when we look at the concept of the harmonization of accounting regulation within the European Union, we could see that this issue has been addressed before by the European Commission, and the result is so-called accounting directive. Still, if we look at how the accounting directive is being assessed by the professional community, by the academic researchers, we could see that the voice coming from this assessment is very clear. It's the criticism because the accounting directive led to the 27 different accounting systems where the comparability of the financial statement across the European Union is relatively low. And at the moment, the topicality of this issue is raised again at the very high level, namely the Capital Markets Union initiative, which stresses the importance of the capital mobility within the European Commission, which stresses the importance of the transfer from the bank-based to the market-based financing for all the type of the stages of entrepreneurship, namely starting from the startups to the micro to the medium, small and medium enterprise. At the moment, the alignment of the reporting is done only for the public companies, which is covered by the full IFRS regulation. And here, when we talk about the SMEs and which form the backbone of the European economy, the aligned reporting, financial accounting legislation could be based on the IFRS for SMEs, but the European Commission, the European Union is reluctant to adopt the IFRS for SMEs. And that is why the aim of this article is to explore a background for a harmonized regulation framework for SMEs financial reporting obligation, identify the difference between the IFRS for SMEs and the EU accounting legislation, and recommend legislative changes necessary for the EU-wide IFRS for SMEs implementation. The academic research on the accounting legislation, on the aligned accounting legislation and the international standard could be divided into several blocks. The first one is being the overall structure of the accounting legislation and alignment between the countries. While the European Union emphasizes the supranational role, and which is the crucial for the alignment, for the consistency and comparability of the financial reporting across the EU, the studies such as Gross and China point on the very similar functions between the national, supranational, international accounting regulation. Then Posner emphasizes the difference between the national regulation. This is what is crucial, and this is what is creating the obstacles for the cross-border economic development. Additionally, when analyzing the international standards and international frameworks, several studies such as NOPS and Kotari et al. Emphasize that even though we have the global standards, global attempts to align the accounting regulation, there are the country-specific, there are the national specificity, there is the difference on the national level, and this will remain. So if we look at the full IFRS research, then there is a vast academic research present. There is a lot of recognition of the implementation of the full IFRS, and still we see that several researchers, several academics point that such countries as US, such countries as Japan, China do not apply the full IFRS, and those are the very important countries on the economic map of the world. So when we turn to the IFRS for SMEs academic research, then here we see that the authors mainly focus on the developing countries and the implementation of the IFRS for SMEs in the developing countries, because this is where at the moment the IFRS for SMEs are implemented. In general, when looking when looking at the IFRS for SMEs, the authors tend to compare them to the full IFRS. And here, of course, the simplicity, relative simplicity of the IFRS for SMEs is stressed. For example, Bohusova has stressed that IFRS for SMEs are relatively easier in the areas such as financial instruments, goodwill, intangible assets, R&D, or the areas which are not so typically applied by the SMEs. Still, Hiblova indicated that the level of complexity which exists for the IFRS for SMEs is still relatively high. The criticism for the IFRS for SMEs is mostly concentrated on the complexity and on the cost burden. The cost burden is stressed by Batista and Meyer et al., Hiblova, Kai and Koch. For example, Batista and Meyer stressed the conversion issue from the local standards to IFRS for SMEs. Hiblova stressed the cost of training and preparation of the IFRS of the financial statement on the IFRS for SMEs. While Kai and Koch stressed that extra costs or especially costly this implementation would be for the European civil law countries where there is the tendency to link the accounting legislation to the insolvency and taxation legislation. However, the other authors such as Damak Ayade et al., for example, stressed and emphasized in the research that it's quite normal to have relatively higher costs when we talk about the higher transparency and the alignment. While Kai and Koch indicated that there is no proved empirical link between the presence of the standards in the country and its ability to apply the additional loans. The additional area of criticism by the authors is the complexity of the IFRS for SMEs. And here the first issue, which is indicated by several authors, is the presence of the cash flow statement, which is a requirement by the IFRS for SMEs to be prepared by the companies, while the current EU accounting rules do not require the cash flow statement to be prepared by the companies. In general, when looking what is the SME and under the IFRS for SME and under the current definition of the is applied in the European Union and which has the characteristics of the size of the balance sheet, of the number of employees, and so on, we can see that there is no the definition of by the ISB, International Accounting Standard Board, and the current definition applied in the European Union, they differ, and this is stressed by Warren et al. On that the contradiction exists. And then again, if looking where the application of the IFRS for SMEs is at the moment is present, then the authors such as Batista, Meyer, Bohusova, Kai and Koch, they stress that this is developing countries, and the factors which they find to be related to the implementation present for the IFRS for SMEs are the common law jurisdictions and the previous application of the full IFRS. This is Kai and Koch, Banita and Pais, and Banita and yes, and Banita and Pais have the similar result to Kai and Koch. Additionally, Salami and Gafsi also indicate that the countries reliance on the external funding is what additional stimulates to apply the IFRS for SMEs. Corinna, I'm giving the floor to you. Mm-hmm.
Okay, so the framework of the EU's legislation on financial reporting is aimed to ensure consistency and comparability across the Union, and it promotes the global convergence of accounting standards, which is achieved mainly through the implementation of full IFRS for a consolidated statement of listed companies by the Regulation 1606/2002 EC. And as part of reviewing the EU's accounting regime in 2011, an impact assessment establishing several policy options was carried out. And this review and the impact assessment had the goals of reducing administrative burden on small companies, increasing the effectiveness, relevance, and understandability of financial reporting, and facilitating the functioning of the EU single market and encouraging cross-border business activities. Within those policy options, there was the option to create a wholly new accounting framework by adopting the IFRS for SMEs across the European Union as mandatory. But eventually this option got rejected, and instead in 2013 the European Commission chose another option, the adoption of its new directive, the so-called accounting directive. It's Directive 2013/34/EU, by merging and improving its predecessors. The incompatibilities of the EU accounting directive with the provisions of the IFRS for SMEs are amongst the main reasons for the EU's continuously reluctant attitude. And as we already heard, the problems with the incompatibility start already at the level of the definition of an SME. So the European Commission defines an SME as an entity that has a balance sheet total not exceeding 20 million of net turnover. Then they also have quantitative size criteria for the net turnover and the employee number, or the average employee number during the year. Compared to that, the ISB has adopted a wider definition where an SME is every entity that is not publicly accountable yet publish general purpose financial statements for external users. So these diverging definitions lead to two potential problematic scenarios in the hypothetical case of an adoption of the IFRS for SME on EU level. So there is the one case where an entity is an SME according to the IASB definition, meaning it's not publicly accountable, but it exceeds the quantitative size criteria by the European Commission. In that case, the adoption of the IFRS for SME would mean that probably within the EU, the European Commission's definition would prevail, and therefore some entities which would be entitled by the IASB would not be entitled to report under the IFRS for SMEs. The second case is that an entity could be an SME in accordance with the European Commission, but not in accordance with the IASB, meaning it complies with all the size criteria, but it is publicly accountable. In that case, even if the European Union implements the IFRS for SMEs, there would be some companies left that are not SMEs in accordance with the IASB, and for those companies, the European Commission would still have to have additional regulation. And with this, we come to the next slide. So the EU accounting directive, which was mentioned to be made the option as opposed to the IFRS for SMEs, mainly companies that are not subject to the full IFRS and would theoretically be eligible subjects to the IFRS for SMEs, currently fall within the scope of this directive. The main points of critique are that the European Commission's Small Business Act did not find consideration, and also the focus on the most commonly used principles and policies is not suitable to make the most efficient accounting environment. The principle of subsidiarity and proportionality were also not sufficiently considered in the drafting process, and the various member state options are degrading the harmonization efforts and the capacity of financial statements to provide for comparable information to users across the European Union. So the incompatibilities of the EU accounting directives with the IFRS for SMEs were identified by the EFRAG, by the European Financial Reporting Advisory Group, and those concern the areas of extraordinary items, financial instruments at fair value, amortization of goodwill and the underlying useful life, recognition of negative goodwill in profit or loss, presentation of unpaid subscribed capital, and the reversal of goodwill impairment losses. Additional incompatibilities with the IFRS for SMEs were already partly mentioned. So there's no cash flow statement, no cash flow statements could be required by a member state from small entities. It could be required in addition to the balance sheet, profit and loss, and notes to the financial statements for medium-sized companies, but not for the small entities. And this is already touching the second point. So since there is no classification into micro, small, and medium-sized within the IASB, this point is not compatible, because whereas in the EU, small entities should not be required to make a cash flow statement, within the IASB, all SMEs have to publish a cash flow statement. So while the parallel involvement of IFRS for SMEs and the accounting directive took place with limited potential to renew the motivation for the alignment, the increasing focus of the European Commission towards the creation of a united capital market could change the situation. Through the objective of creating a capital markets union, the CMU, the European Union aimed to remove obstacles to cross-border investment, to diversify the financing of the economy, and to reduce the cost of raising capital. The accounting directive was deemed ineffective by some concerning its contribution to the objective of an integrated capital market. While the objective of the Capital Market Union is a cross-border investment where the size of the companies in focus covers the SMEs, we concluded that it's therefore necessary to re-examine whether the accounting directive is an appropriate means of regulating and harmonizing the accounting obligations for small and medium enterprises, or whether the IFRS for SMEs could be of greater benefit in achieving the objectives of the Commission's Capital Market Union's initiative. In our conclusions, we found that the full IFRS provides for a qualitative, internationally recognized and widely acknowledged set of rules that is intended to improve the international harmonization of accounting legislation. However, strong EU involvement in the IASB's standard setting process is considered desirable, even though the EU is already exerting considerable pressure on the standard setting board. The current EU legislation on SMEs financial reporting is not achieving a sufficient degree of harmonization, and the IFRS for SMEs could be an effective alternative because it carries the potential to follow the example of the full IFRS and to improve the degree of harmonization of accounting rules for SMEs. Due to the diverging definitions of an SME, only entities that qualify as SMEs under both definitions are eligible to apply the standard, so that an all-encompassing replacement of the European Commission accounting requirements for SMEs by the standard is not feasible. Implementation of IFRS for SMEs is unevenly spread to this day and skewed to the developing countries. Common factors determining a country's decision of adopting the IFRS for SMEs are the experience with applying full IFRS, absence of national accounting standards, a common law environment, and the reliance of external funding. The main drawbacks of the IFRS for SMEs is the cost burden for SMEs. The standards complexity is still too high for small companies, and this goes along with the fact that there is no separation of small and medium entities. However, the main advantages seen in the IFRS for SMEs is the potential decrease of cost of capital and the country's improved ability to attract investment through implementing the standard, and this would result in economic growth. And this corresponds to the aim of the ongoing Capital Markets Union project. So there is a necessity to re-examine the EU accounting directive, which is mainly criticized for its large number of member state options, which are degrading the comparability of financial statements and hampering the overall harmonization objective. The ineffective contribution to the European Commission's ongoing policy objective of creating an integrated capital market, as already mentioned, makes it even more necessary to re-examine the EU accounting directive. So initially by the EFRAG, there were 6 incompatibilities found, and the suggestions that we are making is to introduce a common SME definition for the European Union and the IFRS for SME, so this incompatibility of definitions could be solved, and to re-examine the EU accounting directive and to examine whether the IFRS for SMEs could be the better alternative. So we thank you for your attention.
Thank you.